Hello there, Adam Gower here, and welcome to the GowerCrowd Podcast, the real estate crowdfunding show Deal Time, where you can learn about active crowdfunded real estate deals directly from the sponsors themselves. Subscribe to my free weekly newsletter at GowerCrowd.com, where you'll get links to the podcast, as well as news and updates exclusively from the world of real estate crowdfunding. Sign up at GowerCrowd.com so you don't miss out. Also, if you want to pitch your deal on the show, just go to the podcast page at GowerCrowd.com and look for links on how to submit your deal. Please note that while I don't endorse the deal, sell securities, or make investment recommendations of any kind, some sponsors are GowerCrowd clients. Now listen in and learn about the next great deal on the GowerCrowd Deal Time podcast. Here we go. Chris, great to see you. Thanks for being on the podcast. Please, let's kick off with your name, company name, and position. Then we'll talk about the fund.
Sounds good, Adam. I'm Chris Benson. I'm the Chief Investment Officer at Reliant Real Estate Management.
All right, and you've got a fund, haven't you? So tell us about the fund. What are the parameters? Can we give the 50,000 foot overview?
Yeah, the easiest way to think about the fund, Adam, is as your listeners may or may not know, we're a self-storage operator. So we're buying and managing self-storage properties. So think about it this way. It is a mutual fund of self-storage properties, right? As opposed to buying an individual stock, you're buying a portfolio into a portfolio of stocks. And in our case, those stocks are self-storage properties. So we are raising a $50 million equity fund. And that $50 million will be deployed into acquisitions primarily across the southeastern part of the United States into three distinct self-storage strategies. A little bit of ground up development, perhaps, time will tell if that actually happens. Value add, which will be where the bulk of the equity will be deployed, and then into stabilized assets. So properties that are stabilized, we're just going to rebrand them and clip coupons. So at a high level, the fund is an opportunity for investors to access the self-storage asset class in a diversified portfolio of holdings.
Okay, and in terms of the value add assets that you're looking for, shed some more color on that, if you would. Size, just give me some more details. If I'm coming into the fund, what are you looking for? Maybe I know one in the local neighborhood, so I need to know what you're looking for.
For sure. So, if you think about value add, it's in its essence, how do we grow NOI at a particular facility? And there's a few different strategies we use to get there. The one that stands out to most people in self-storage is, we build additional storage. So we have a cash flowing asset already, and we feel there's additional demand in the marketplace for something. And maybe it's, just more space. So maybe it's more climate control units. So we'll build out, I'm using an arbitrary number, but 20,000 square feet of climate control units. And the value add is really getting those units from empty to full. And when we get them full, there's more revenue, which means there's more NOI. So that's one strategy. Another strategy, Adam, is really around management prowess. So we'll plug in our professional management platform into some facilities where maybe they haven't been managed up to their full potential. And I'll give you a couple examples. So ancillary income are items that we love to add to self-storage facilities. So in addition to the rent that you're getting for renting the units, you also have the opportunity to do things like U-Haul truck rental, tenant insurance programs where the tenants are required to insure the goods in their unit, and we can share in the revenue streams there. Retail items, so locks, boxes, moving supplies. Those kinds of things we would consider low-hanging fruit that we can plug into a facility, and again, add value through growth of NOI.
What are your underwriting standards in terms of the kinds of returns that you look for when you underwrite a deal?
Yeah, in this fund, Adam, I would say that's kind of given us the parameters in which we underwrite to. Our projected returns on the fund are between 12 and 15% a year. And that includes the dividends we're paying quarterly and the profit from sale. So when you're all said and done, that's where we want to end up. So when we're underwriting a deal, our acquisitions team generally is trying to fit into that box. Now, because it's a portfolio of properties, you may have some that are a little higher, than that 12 to 15%. And you may have some that are a little lower, but on average, they're going to try to get into that window. So that's really where we try to underwrite to.
What is the term of the fund? What's its lifespan, and what's your capital call period?
Yeah, so the first question of what is the term of the fund, the projected hold period is 6 years. What I would say is investors should be comfortable that could be potentially longer, or it could be shorter. We at Reliant have sold 38 properties in our history, and our average hold time is just over 3.5 years. So if there's an opportunity to essentially get year 6 value in year 3, then we're generally going to take that opportunity off the table. So, but the second part of your question is, what is the capital call period? So our fund's a little bit unique, Adam, than some other funds where there is no 3-year acquisition period. We're generally taking capital and deploying it right away into properties. So our previous fund, Fund 1, and we're in Fund 2's vintage now, but Fund 1, we raised and deployed $47 million in equity over 11 months. And we expect Fund 2 to be similar as well.
Let's talk about what's in it for investors. What's the minimum? I know you've got multiple layers, but what are the minimum investments?
Yeah, we have 3 classes of share, and there's a different investment minimum for each of them. For our what I would consider retail investors, it's a $50,000 minimum, and that $50,000 minimum gets you an 8% preferred return. With a 70-30 split on anything above that 8%. So 70% goes to you, the investor, 30% goes to Reliant, the sponsor.
Yeah, go on. And then you do have a couple of other classes. Just briefly tell me about those, because it's interesting.
There's a Class B share, which is $1 million minimum, and then a Class A share, which is a $5 million minimum. And what's happening there is the preferred return is the same, but the waterfall structure, the promote, is more advantageous for the investor. So for example, the Class A is an 80-20. So 80% of the upside goes to them, 20% goes to Reliant. And Adam, for all 3 classes, there's one more hurdle, which is a 15% IRR. So if we reach a 15% IRR, which stands for internal rate of return, then the promote, the waterfall, changes. So for example, that Class C share where we said it's 70-30, if we hit that 15% IRR, it goes to 50-50. So what it means, it incentivizes us to outperform. If we outperform, we want to be able to take more of the upside.
And explain to me how an investment in the fund works. If I say I want to invest $100,000 today, and I send you, I wire the money, to sign the docs and wire the money, first of all, will you accept it today? And secondly, when will pref start to accrue?
From you, I wouldn't accept it. Your money's no good there. But what I would say is, so that $100,000 begins to accrue the preferred return when it's deployed in a property closing. And how we have it set up in our subscription documents is when your capital gets deployed in a closing, the timer on the 8% preferred return begins that date. Now, if for some reason we didn't deploy your money, let's say a property closing fell through, we didn't have a property to close on, but we took your money. How our subscription documents work is ostensibly we have your money for free for 90 days. On day 91, whether we've deployed it or not, you begin to accrue that preferred return. Now, what I would say is we're very thoughtful when we take money because we know that clock is going to start ticking. And generally, we're trying to take money and deploy it within 45 days. So if we take your money today, it should be deployed, let's say, before the end of May.
What's your co-invest? And fees.
Yep, good questions. So I'll take those in 2 separate parts. So in the $50 million fund, Reliant will invest $1.5 million of its own capital. So that from the principals of Reliant. The other part of that I would say from a co-invest is we're also signing on the notes. So if there is recourse debt, the principals of Reliant are signing on that recourse debt. We don't charge a loan guarantee fee. That's part of our skin in the game. The second question of what's the fee structure? There are 4 fees in Fund 2, Adam. 2 of them are one-time fees paid at closing, and then they disappear. And then there are two fees that are paid out of the cash flows of the property. So the two fees that are paid at closing are the acquisition fee, which is 2% of the all-in cost of the project. That's paid at closing and goes away. There's a development fee, which is 6% of any CapEx on the property. So if there's a capital expenditure budget to build out that 20,000 square feet, we're getting 6% of that CapEx, and you're paying as an investor your pro rata share of that. And again, that's paid at closing, goes away. Then the two fees that are coming out of the cash flows of the property, one is a property management fee. And I started the call by saying we are our own property manager, so we're paying Reliant, the property's paying Reliant to run it. That's 6% of gross revenues on the property. And then the second fee is the asset management fee, and that's 0.65% on the equity deployed in the fund, and that's on an annual basis. That's how you calculate the fee. And those two fees go until we sell the assets.
And what is the fund's leverage policy?
Yeah, another great question. So the fund endeavors to stay below 70% loan to value. So like in Fund 1, we ended up at just over 68% loan to value. In Fund 2 right now, we're at about 66%, if I'm not mistaken, based on the 7 properties that we have right now. But we will 100% be below 70% loan to value on the fund.
So individual deals can have higher leverage, but overall the fund aggregate leverage will be no more than 70%.
You got it.
Is for somebody investing in the fund, it's a long life cycle, right? 6 years, could be longer, as you've said. Are there any early exit provisions for investors?
No. You're saying, Adam, if that $100,000 you invested, you come to me 3 months from now and say, hey, I need
or in 3 years, the breadwinner passed away and I need some immediate cash to pay debts or whatever.
No, and this is one of the downsides of these private placements, at least from us, is, this money is illiquid, and you should think of it that way as an investor. If you're not comfortable with that 6-year or maybe 10-year horizon, then if this is capital you need in a couple of years, then this shouldn't be money that you invest in the fund. And look, we could turn it sooner, but we just ask as investors to think about it as, long-term illiquid investment.
We've touched upon this already, but what is the exit plan for the fund? Like, how have you underwritten that? And what's the idea?
Yeah, so there's a couple different ways. How we underwrite it in the pro forma is a sale, right? And we assume a specific cap rate of selling the portfolio at some point in the future. What I would say is that in real terms, there's really 2 ways that happens. One way is we sell the portfolio, right? So one of those REITs that we had mentioned, a publicly traded REIT or institutional capital, says, hey guys, you built this 10 property portfolio, we'd really like to buy it. And we sell the entire portfolio. The second option is a redemption, Adam, where ostensibly a new group of investors come in and say, hey, we really like these assets. Let's redeem out our current investors and we'll put our capital in. And usually that happens because that bucket of capital has a different appetite or a different return requirement than the current capital in there. So, we're projecting kind of the mid-teens return for Fund 2. Maybe there's a group of investors that say, hey, we don't need mid-teens. We'd like a 6 or a 7 and just want it to be really safe. Well, those investors could buy out the current investors, and then we, Reliant, still own the property just with a new group of investors. So really, those are the 2 methodologies that we would create an exit for our investors.
Okay, interesting. All right, so let's wrap up with 2 hyper investor focused questions. One, who is your investor avatar? Like, who are the ideal people to consider investing in your fund?
One, you have to be accredited. This is a Reg D 506C offering. So all of our investors in the fund are accredited investors. If you don't know what that means, you can Google it for sure. But what I would say, the perfect investor, Adam, really is someone who's made the decision. There's 2 paths you go as a real estate investor, a passive investor or direct. Reliant is a direct investor, right? We're doing the work, going out, buying the facilities and managing them. There are many people who say, they have a good day job. Maybe they own a business, they're a doctor, lawyer, professional, whatever it is, but they generate a lot of income and they say, look, I like what I do every day, but I do want access to the asset class. And so I'd like to deploy capital with a professional operator. And for us, those are passive investors that we would expect usually come and play with us, right? And they're saying, look, Reliant, you've been doing this for a long time. We trust your team. We trust your track record. I'm not going to go do this myself, but here's a chunk of capital. I want access to the asset class.
For an investor who tunes into the podcast, I'm not sure how you would do it. You could do it on radio at the last minute, miss the bulk of it. But on a podcast, it's very difficult to do. But assuming somebody was to tune in and only hear the last few sentences, what would you want them to take away from this podcast?
Yeah, I would want them to understand that any passive investment is really an investment in people. And that's all that matters, because once you write your check to us, Adam, you have no control. And I don't mean to sound crass when I say that, but I want you to understand as investors that you're truly trusting the operator you're investing in. And that means you're truly investing in the team that's running the investment. And so for us, what we like our investors to understand is who we are as people and our track record, because generally that's going to be the best predictor of future results. So if you've only heard the last 2 minutes, what I want you to walk away from is invest with great people with a great track record, and generally things will turn out okay.
Chris Benson, Reliant, thank you so very much for being on the podcast. Always a pleasure to see you.
My pleasure, Adam. Thank you so much.
If you want more information on this deal and on all the others in this new series, plus if you want access to the latest news from the real estate crowdfunding industry, and if you want to be the first to know about some amazing proprietary industry data that we're putting together for you, subscribe now to the GowerCrowd newsletter at GowerCrowd.com. It's totally free, and it is the most comprehensive source of news and information about real estate crowdfunding anywhere on the planet, all there at GowerCrowd.com. Thank you for joining me and for listening in to today's deal. This is Adam Gower wishing you well and signing off.